Hi, I'm Adam Carlini. With me is Grant Haddon. We are with Dynamic Wealth Management. Behind the camera today is Gary Luna, our other partner. And we're excited to share with you our update and insights into what's going on with the market and the economy.
Yeah, it's been a bumpy year in 2018, but all of a sudden it's starting to move upward. So we're excited to talk about the end of the year and seasonality and where we see this market headed. So we'll jump into the charts and go from there.
Sounds good. So let's get to it. It's September 10th, 2018, Dynamic Wealth Management update of the markets and the economy. And Happy New Year to our Jewish clients. Rosh Hashanah started last night at sundown. So Happy New Year. Hopefully this will be a great new year for the markets and for all of us. Before we get going actually into everything, let me just highlight an upcoming event. We've got our investments for breakfast starting back up after our summer hiatus. That'll be starting on October 9th, 9 a.m. in our conference room. That's Tuesday, October 9th. Remember to bring your friends and anyone else you know who's interested in the markets and the economy and have questions. We'll be happy to answer them and have the open discussion. All right, looking at some key events. Yes, we did it. We're now officially in the longest bull market ever as of August 22nd of this year. You can see that, here it is right here. It wasn't as spectacular as the previous one, but we're now beyond it. And so how long will it last? That's the big question. We'll try and answer at least whether it can keep going or not in the upcoming slides. So looking at past bull markets, while this one is the longest in duration, it is not the longest by percent return. We actually had another one back in the 30s, but the most recent one was this big one that ended at Y2K. This was the one that we actually just surpassed, and it was almost 100% higher return than where we are. So is there more room for some more upside? Certainly there is, and right now we don't see anything on the horizon to suggest that the market is done going up. We may have a little pause because we're in September, which is usually the worst month for the markets, and then October is the most volatile. But everything that we're looking at right now suggests that the market has sufficient legs to keep going. For example, if you look at the strength of past expansions, here are some of the other expansions that we've seen in the past. They were much sharper when they peaked out. So here we are. We've been going at a very steady pace. So I guess if you want to look at the cup half empty, you could say, gosh, we've had too much of a rally considering how slow of a pace we've been accelerating this time. If you want to look at it from a cup half full in a positive way, you'd say, well, so far we've been going slow and steady, and we actually could accelerate quite a bit more before we hit a peak. And so it's looking like this market's got legs to go. Looking also at the acceleration in the economy, the average GDP growth over this significant period of time has been 2.7%, and the expansion average that we've been in just recently has been 2.3%. And you'll notice now that year over year we're up 2.9%, so that's better than the actual average. And quarter over quarter we're accelerating. We're now at 4.2% versus our average up to this point of only 2.3. So actually we're seeing a strengthening in the GDP and in the strength of the underlying economy, and that would bode well for the market. We've always got events happening that can cause short-term fluctuations, but the overall long-term right now looks positive. Grant's going to go ahead and discuss the response of the markets to these events, which is actually the more important part because it's how the market responds that matters. So we'll turn it over to Grant to cover where we're at in the market and how those trends are looking.
All right, well, let's jump into the stock market now that we've heard a little bit about the economy. So first, let's talk about stocks versus the dollar versus commodities versus bonds. So we're looking at year-to-date numbers here. Obviously, stocks have done the best, up 7.6% year-to-date. The dollar has actually done well. I mean, looking back into April, it was negative a few percent, but since then, the dollar's really been on a tear. And really, that's due to international markets not holding up very well. As foreign countries struggle, you tend to see the dollar go up in value, and that's what's happened over the last 5-6 months here. Commodities have been up and down kind of all year, but they do have an inverse relationship with the dollar. So as the dollar's been going up, commodities have been coming down. Bonds, look at bonds, just floating negative all year long, down, somewhere in that range of 2 to 4% negative all year long. So not a lot to get excited about bonds. So obviously stocks has been kind of the place to be, and that's why we have our models have been overweighted towards stocks. Now let's talk about within stocks. So we know stocks are doing well. Well, which major indices are doing well? Well, here's the S&P 500, kind of in the middle of the pack, 7.6%. That's what we talked about, right? Well, actually, small caps, the Russell 2000 has outperformed the large caps in the S&P 500, and even better, NASDAQ technology has done even better, right? So that's Amazon, Google, Apple. That's what's pushing the NASDAQ up. Now, we do have the Dow down here on the bottom. So another thing to note is that in our models, for those of you who are clients, you know that we've overweighted towards the NASDAQ and towards the Russell 2000. So actually, that's why our core ETF models are outperforming the S&P 500 this year, and we're actually beating the market. All right, let's jump into this chart of the S&P 500. So this is the last year of the S&P. So man, the end of 2017 was just so strong. Since then, 2018, like we said, has been kind of a bumpy year. It's been in this box. So if you watched our last video, then we drew this box, and you saw that, and it was right here at our last time we made a video. And so what we said is, this is a key level, because if we break out of this box, it's going to be a good thing. And not only did we break out of the box, but it continued to uptrend. And actually, we beat this all-time high level. And even though we've pulled back a little bit over the last few days, this market is looking very strong heading into the end of the year. All right, so let's break it down even a little bit farther and talk about some other major indices out there. So again, we went through these ones, right? Small caps and NASDAQ are beating the market, and that's why we've overweighted towards them. But another thing to point out is the international markets have been doing very bad, as we pointed out. So international emerging markets is down 12% this year, and developed international countries are down 4.5%. So definitely has paid to lean towards the United States market, which we have done, towards the domestic market. And actually, we don't hold any international holdings, and we haven't for the last couple years. So we have benefited from that, and so have our models as well. All right, where are we allocated right now? Well, we're still in a green zone. You'll notice that our ratio is up above our yellow line and our red line. So we're in there. We're in our most aggressive allocation right now, and we'll stay there until the market turns on us. So again, another indication we are in our bullish green zone. What does the green zone mean? The green zone means that if you're a growth client, you're 100% in stocks and equities right now, and no defensive holdings. If you're a moderate client, you're 80-20. If you're a conservative client, you're 60-40. But this is the zone. So depending on if you're a growth client, a moderate client, or a conservative client, here is your current allocation. All of them are leaning heavier towards stocks, which has obviously benefited us over the last couple years. Here's the sector rotation model. Here's the current holdings. Remember, this is a quarterly model, so we will be reallocating this model on October 1st. And so 3 weeks away, we'll be taking new trades, and new sectors will rotate up to the top line here. All right, thank you so much for watching our video. We like to keep these short and sweet so that we don't bore you and just give you the highlights. That being said, obviously we're not making any specific recommendations. Please consult with your financial advisor before you make any major money moves or financial decisions. Thank you for watching our video. We'll put out another one soon.